Does the UK budget mean that your mortgage interest is going to go up? How does it all work? Sadly, most people don't understand the bond market. It was famously said by Bill Clinton that when he's and if he's born again, he'd like to come back as the bond market because governments soon realized that the bond market is more powerful than they are, as Liz Truss and the rest of us found out. So, how does it work? Also, just as an aside, you might have seen during the UK budget this week that the Deputy Speaker of the House, who sits as Speaker during budget debates, admonished the government for leaking details of the budget on the basis that Parliament is sovereign and therefore those details should have come to Parliament first and be debated in the House and not in the media. The problem, of course, with that is, had the government not leaked and managed the flow of information before the budget, it could have caused greater alarm in the bond market. So Parliament is legally sovereign, but actually, financially and economically, sovereignty is shared, just as it was when we were part of the EU, with other institutions, including the bond market. And that's one you can't exit unless you decide not to borrow money. So let's get back to how bonds work. They're basically loan notes. The government asks to borrow money. It might borrow it from institutions such as pension funds. Your pension, for instance, might lend money to the government. Why might you lend money to the government? Well, you think it's a pretty safe bet that you're going to get your interest payments and your capital back. Other governments might buy those bonds, such as the Chinese government, for instance, might decide to lend money to the British government because it needs to earn some interest. The way bonds work is if you think of supply and demand, which we all understand, if you supply a lot of anything, including bonds, then the price of that tends to go down. The way bonds work is that if the price of the bond goes down, the yield or the interest you're going to receive on the bond will go up. Don't worry how that exactly works, but what you've got to remember is supply means prices drop, which means yields go up. And of course, if yields go up, then maybe people will buy some more. Therefore, supply starts meeting demand, and you get an equilibrium and you get a fixed rate of interest. Right. So, what's happened and what's the government said, which might cause bond yields to go up? And if bond yields go up, you can assume that mortgage interest rates, which you, of course, think are set by the Bank of England, which to some extent they are, but because they operate in the financial markets, the bond markets can determine what happens with the Bank of England rates and therefore your high street retail bank interest rates on your mortgage. So what's happened with the budget? What's happened is that the government said they're going to borrow a lot more money, which means issue more bonds. So they're going to supply more bonds. So the price of bonds falls because there's going to be more of them. So the price falls. Supply and demand with anything, if there's more of it, the price tends to fall. And that means that the yields have gone up. The interest that the government will have to pay to borrow that money has gone up. Of course it has, because if the government wants to borrow more money, guess what? People out there are going, you want to borrow more money? Fantastic. Make the interest rate higher, okay, to make it attractive to the lender because there's a lot more debt they can choose from to finance. So you've got to make the interest rates higher and more attractive. That means that the Bank of England is less likely to reduce interest rates because whilst it might try, the way it finances its operations necessarily are linked to the bond market. And if the bond market yields have gone up, the Bank of England has its hands tied to some extent how quickly it can reduce interest rates, which means your retail bank from whom you're borrowing money is less likely to be able to cut interest rates. Essentially, what it means is not so much that your mortgage is going to go up, but don't expect an interest rate cut on your mortgage in December. It's going to stay higher for longer at these rates. Now, that's a trade-off that the Treasury and the Chancellor were probably happy with. Whilst everybody in the media is talking about, oh, she spooked the markets, not as bad as Liz Truss, or is she, etc., etc., it's a trade-off they'll be happy with because it's not led to higher rates. So what you're suffering is not a higher rate, which you would notice and go, bloody hell. Instead, it's an opportunity cost of a missed opportunity of lower rates, which is psychologically less painful to people. to the extent they might not even notice it, and the politicians can fluff around it. So, in a way, she's dodged a bullet. Yeah, the headlines are talking about bonds dropping off a cliff, etc., etc. It's actually barely budging. Essentially, you're going to pay the higher mortgage for a longer period. Of course, that has ramifications for house builders. They've seen their stock price drop. Who cares? Basically, you can whinge about it all you want, but government will say prices go up and down. Could impact people looking to buy homes. They're going to be less affordable for longer. It's hard to put your finger on it with these kinds of indeterminate things of alternative histories and what could have been, which is great for politicians because it allows them to argue either way, a bit like lawyers and economists. So in the end, essentially, she's dodged a bullet. We've not seen a collapse of the bond market as we did after Liz Truss, or a collapse in potentially the pensions market. So could have been worse. That's all I can say. Could have been a hell of a lot better. Could have been worse. Given that we knew the government was going to borrow money, I mean, I don't know if that was a surprise to anybody, because it's a new government and they want to spend, and they weren't going to do it by tax rises alone, otherwise that would have been austerity. This was obviously the case. There's another reason why the Bank of England won't reduce your interest rates on your mortgages. Well, interest rates, they don't directly dictate what happens to your mortgage, your retail bank does. And it's this. When the government spends a lot of money, it's called fiscal loosening. In other words, more money in the economy. That could be inflationary. That could push up inflation, and the Bank of England is charged with controlling inflation. Therefore, again, the Bank of England will want to keep interest rates high to keep a cap on that inflation. The Bank of England controls interest rates and the supply of money. That's monetary policy. So if you've got fiscal loosening, almost certainly you're going to get monetary tightening to keep a cap on inflation. Monetary tightening, higher interest rates, for instance. Okay, hopefully that explains it in relatively simple terms to everybody. Have a look at my links in the bio. Do like and follow for more explanations on simple matters of economics which will affect you, and also on matters of investing and your pension. Thank you very much.